So this is part 4 in building wealth for software engineers. We're going to be talking about taxes today, and before we start, I just want to make clear that I'm a software engineer, I'm not a tax professional, and so you should not think of this as tax advice. This is more just ideas that I've come up with doing my own taxes, and if you want to see if these ideas apply to you, then you should consider them for yourself or go talk to an actual tax professional. Okay, so now that we kind of have a basic understanding of the different concepts for how the taxes are calculated, we're going to talk about how can you reduce those taxes? What are your levers for reducing those taxes? And those levers are, the biggest ones certainly are having 401k contributions. This is going to reduce your income, or it could reduce the capital gains that you pay on investments. The next one is a after-tax 401k. It's also called a mega backdoor Roth. This is one that will reduce your capital gains tax. The same for the regular backdoor Roth IRA. If you move to a state with no or lower state income taxes, that is going to reduce your state income tax rate. And if you get married, kind of in the example that I gave before, the rates that are applied to, the marginal rates applied to your income are going to be different and generally going to be lower, assuming that your spouse doesn't make a similar amount of money as you do. And then you can try to increase your deductions by giving more to charity. And there's a couple other levers that are more specific to investments, which we'll talk about in the investment section. And those are the step-up basis, which happens when you die. The cost that's used to calculate the capital gains tax rates, or the capital gains that you have on your investments, will go up to the value at which they are when you died. And then there's also something called tax loss harvesting, which is used to reduce your capital gains by incurring losses on assets that you own. Okay, so should you max out a 401k contribution, and do you want to do that with it? Do you want to put that into a traditional or a Roth 401k? So what are 401ks in the first place? These are retirement accounts that are tied to employers. So with each new employer, they might have their own 401k programs, and you'll have different accounts if you move to different employers. There's kind of two kinds of 401k accounts. There's traditional and then there's Roth. Traditional, basically how that works is that you're not paying income taxes, when you put the money in, but you pay the income taxes when you take the money out during your retirement. And you will pay income taxes on the growth of that money as well. With Roth 401ks, it's sort of the opposite. You pay your taxes at the beginning when you put your money in, but then when you take the money out, there aren't any income taxes associated then. Generally, for both of these, there are going to be rules and penalties if you're taking your money out before 59 and a half years old, except for specific exceptions. Okay, if your program has a match, you always want to get the match. That is just like free money, basically. So you should always be contributing up to the match. Most likely, it's going to be a good idea to max out your contributions up to the $1,000 threshold, that limit that is there. And generally, it's better to be using the traditional over the Roth. So let's just say that you have about $200,000 income at E3. We're assuming that you're having a 35% tax rate now, and that when you decide to take the money out, you're going to be having an equivalent income of around $100,000, and your tax rate is going to be about 27%-ish. This includes federal, state, and local income taxes plus payroll taxes, and that you're going to take it out in about 38 years when you're first able to. We're going to assume 7% nominal returns each year in the stock market with the investments that you're buying, and 2% inflation rate. So the tax benefit in today's dollars of going and putting $23,000 into the traditional 401k is going to be $24,000 compared to putting that same amount of money into a taxable account. This is assuming that there's no match in your program. If you have a match, then this number goes a lot higher. If you took the same amount of pre-tax money and instead put it into a Roth 401k instead, so the contributions, you would have an extra $13,000 instead of $24,000. So generally, it's a good idea to be putting it into the traditional. And the reasoning for that is that you're going to have a pretty high income, or software engineers typically do. And if you have a high income, you're not going to be having that same high income when you're retiring, because you're not going to have work. You're going to have other income sources like Social Security and your investments, but you're generally not going to have as high of an income then. So you should be paying a lower tax rate then. So you want to be putting your money in without paying taxes initially, have time for that to grow, and then take it out strategically when you're paying less taxes, income taxes later on. So should you use the after-tax 401k? It's also known as the mega backdoor Roth. The limit for traditional and Roth 401k contributions is $23,000, and that's in 2024. It's more if you're over 50 years old, and most people know this limit. Most people don't know that if you and your employer's contributions don't go over $69,000, then you can actually contribute after-tax dollars to your 401k program. Now, these after-tax contributions can be rolled over to a Roth 401k. It's called an in-plan conversion. And when you have money in the after-tax 401k, you have to pay taxes on capital gains. If you do this in-plan conversion, they will usually convert it almost very quickly, like almost every day or every week. And so in that situation, there's not been that much time for your contributions to have had any capital gains. So this really helps you to basically avoid the capital gains taxes for after-tax 401ks. Once it's in the Roth IRAs, you've already paid taxes, income taxes on this money. So it gets to grow without having to pay more income taxes when you take it out. The approximate impact of this is, let's assume that you're maxing out the 401k, as I said before, and then you're also maxing out the after-tax 401k. You're contributing $23,000 in the regular traditional 401k. $46,000 is sort of the difference between the $23,000 and the $69,000 limit. This might not be your program might not have this as the main limit. You could have a lower limit, but assuming that it goes up to the federal limit, you would have $46,000 in after-tax 401k. That's going to get converted into a Roth 401k, and this is equivalent to about $61,000 in a brokerage account if you didn't use the 401k at all. And the benefit of putting it into these 401k vehicles is going to be $64,000 in 38 years in today's dollars. And that's going to be 24 is coming from the pre-tax, 40 is coming from the after-tax Roth. Okay, so now that you know what the after-tax 401k is, should you actually use it, assuming that it's available from your employer? Well, a couple of things you should think about. One, you definitely want to have one that has the in-plan conversion, because that's going to really make it much easier for this to work operationally. Otherwise, it's a lot of work. And then secondly, it's about whether you want access to the money now or later. And generally, you can't take money out of it before you're about 60 years old. So do you want to put it in there? And then, even though you could convert a Roth 401k to a Roth IRA, and then 5 years after that conversion, you'll be able to take some money out. That might be money that you need within the next 5 years. So it might be a bit inconvenient there. It sort of makes sense to use this, especially if you are earning so much money that you're really not likely to need the additional money, the additional $40,000 that you're going to put into this after-tax 401k each year. That's when it really makes a lot of sense. And so you can kind of decide what that number is for yourself. But those are sort of the considerations you would have to think through before making a decision on whether to use it or not. So what is a backdoor Roth? And why might you want to use it? So this is a backdoor Roth IRA. And generally, traditional IRAs, individual retirement accounts, they're similar to 401ks in that they take pre-tax money and defer the taxes until you take them out of the account. The reason why they're called individual is because they're not tied to an employer. You can have the same IRA with different employers. And Roth IRAs are similar to Roth 401ks in that you put in money in that is after tax, and then you don't pay capital gains or income taxes on the money afterwards. So if you earn a lot of money, you're not going to be able, and you have this retirement account at work, then you can't deduct IRA contributions off your income taxes. And there's income limits for contributing to a Roth IRA account directly if you earn over a certain amount of money. So this backdoor Roth strategy is another way of getting a Roth IRA indirectly. And to do this, you would put $7,000 into an after-tax money into a traditional IRA, and then you would roll over that IRA, that traditional IRA, into a Roth IRA the next day. And this way, you're basically not paying capital gains tax on the earnings when you retire that are in this Roth IRA, and you get to take out the money after 5 years of your original contributions. You can't take out the gains on those contributions, but you can take out the original contributions to that Roth IRA. So how much is that worth? Each year, since you're allowed to put $7,000 into an IRA, after 38 years, that's going to be worth about $6,000 a year. Okay, there is one reason why you might not want to do this, and you have to watch out for how many other pre-tax traditional IRAs you have. Because if you have another pre-tax IRA, you can't choose to just convert the post-tax contributions into the Roth IRA. All the IRA, traditional IRA contributions are sort of treated as one IRA account. So let's say if you're converting that $7,000, it's going to have a mix of pre and post-tax money in it, which means you're going to have to pay taxes on the pre-tax ratio of that conversion. So let's say you have $7,000 in a pre-tax contribution of pre-tax contributions already in a traditional IRA, and then you contribute another $7,000 in post-tax contributions, and then so now you have 50% that's pre-tax, 50% that's post-tax. You do your conversion. Half of 50% of that $7,000 conversion is going to be seen as pre-tax money. That $3,500 gets added to your income for that year, and you're going to have to pay your marginal income tax rates on that. So for someone earning $20,000, your marginal income tax rate for federal is going to be 32% plus any state. And so that ends up being quite a bit of taxes you're going to have to owe because you're doing conversion of pre-tax money. And you have to know this when you're trying to do the strategy. Another way you can reduce your income tax is to move to a lower income tax state. A lot of people who work in tech are working in New York or California, and those are high income tax states. There are states that don't have any income tax or lower income tax. These include Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. In tech, Seattle is a very popular choice because in Seattle there's a lot of tech options and big tech companies that have large offices there. And so there's a lot of employment options in Seattle, along with the tax benefit of saving approximately, let's say 10% of your income in taxes. So that's one option. You could also move to New Jersey if you live in New York City, for example, and then you won't have to pay the New York City tax. So let's assume that you move to Seattle. With no state and city tax, you're saving about 11% or $22,000 a year, which is a lot of money. And then if you decide that you want to move to New Jersey, you're going to save about 3% on the city tax, and that's going to be $6,000 a year. Okay, let's say that you're in a relationship with someone who is not working in tech and has a normal salary, and you're planning to get married anyway. Then, what is the difference between being a partner versus actually getting legally married? That status change is going to reduce your taxes. And so if you, and this is assuming that they make less money than you do. If you marry another person who works in tech or finance and they make a similar amount of money, then it's not going to change very much for you. So let's assume one person is making $320,000, and the other person is making something around $60,000. That savings of income tax based on having a lower rate is going to be about $9,000. And if you have more income, then this saving goes higher. So another way of reducing your taxes is to increase your deductions, your standardized or itemized deductions. And you can donate to charity. There's a couple of main ways to do that. One is through cash. The other one is through stock or property, essentially, assets. And then really, which one should you choose? The best way is to donate using stock. And when you donate stock, One, you get the itemized deduction on your income taxes for the full value of the stock, and you don't have to pay the capital gains tax that you would have had to pay if you had sold the stock and then contributed the money from selling the stock. So this is a double tax savings for you. Now, let's assume that you're not actually donating that much each year. Maybe you're only donating $1,000 each year, and so you're not actually using itemized deductions on your income taxes. Then you can do a thing where you're basically batching up multiple years of giving into one tax year, and that's using a donor advised fund. So by doing that, you're increasing how much your itemized deductions are for 1 year, so you can actually take advantage of the reduction of your income in that 1 year. And to do this, you're basically putting money into this donor advised fund. When you give the money, it is irrevocable. It means you can't just take the money back from the organization. The charity that's sponsoring this donor advised fund will actually own the money at that point, technically. And so what you can do over time, the reason why it's called donor advised is that you can tell them, hey, I want you to take the money in this account and give it to this charity. Yeah. But generally, if you are donating and you're saying that you want to donate this money to registered charities, 501c3s, then they're not going to have a problem just taking your recommendation. The main downside for using one of these donor advised funds is that they charge a fee of 0.6% each year. This is relatively small compared to what you're saving in the taxes. The good part is that you can still have your money invested when it's in the donor advised fund. And so depending on how much you're giving in your current charitable givings, if you were to put $15,000 into a donor advised fund, that can save you about $4,000 in taxes. Okay, some people might have this thing called a flexible spending account. And this basically is an account where it's used for health expenses. You don't pay income taxes on contributions. The limit is a couple $1,000s. But if you don't use it, then you're going to lose any money that's above a certain kind of rollover limit, which is usually around $500. And so the estimated benefit for this is a couple $1,000s. There's another kind of health-related tax benefit account, and it's called a health savings account. But it's only available if you have a high deductible health plan from your employer. And so should you choose to actually get the high deductible health plan, which is going to cover less, going to have a higher deductible, you're going to have to pay potentially more in order to get the tax savings from this HSA. So first of all, what are the benefits of this health savings account? It's the only thing that is triple tax advantage. Basically, you can pay no taxes on the money that goes into this account, that you don't pay any taxes on the money from the capital gains from this money being invested. You also don't have to pay any taxes, income taxes, or others when you take the money out of the account and use it on health expenses. That doesn't count for insurance premiums, but other health expenses, it will be taxed. It will be free from income tax. And so you also get a contribution from your employer usually for these sort of things. Those are the benefits. The problems are that, one, you now have a health care plan that is higher deductible with higher copays. The problem is that you're probably going to have to pay more out of pocket. this really only works if you don't have any expenses that you're planning to have at all. And the limit here is not that high. It's only about $4,000 that you can contribute to this account for these health savings. And there's going to be some bookkeeping involved here to track the expenses, because the best strategy involved with this account is actually to put the $4,000 into the account, invest the money, and do this for 20 years or so. And at the end of those decades, you can actually then still reimburse from this account for those expenses that you incurred before, which you've paid out of pocket for. So you're going to have to track all these expenses for many years if you want to do it in the most tax efficient sort of way. So whether you choose to do this or not kind of depends on how much you have in terms of health spending and so on. So I'm going to leave that up to you to do sort of the math here. Great. So we finished the tax topic, and now we're going to move on to living expenses next.